Hello, everybody. My name is Brett Pattison. I am a portfolio manager and investment advisor at Iron Gate Global Advisors, and I thank you for taking a few minutes of your time to become more educated on the markets, to gain some clarity, and to discuss something very important, which you see in front of your screen, the global fireworks which are taking place. And speaking of fireworks, I hope everybody had a fun and safe 4th of July. We are in the midst of what they call in the stock market or the markets, the summer doldrums. And I'll talk more about that here in a moment. As I predicted in the June market commentary video, which many of you listened to, we would not see a great month. And that's exactly what's happened. We didn't see a great month. And there's global fireworks, and what should investors do? And that's exactly what we're going to talk about today. Our agenda lays out like this. As we always do, we'll talk about the month before, in this case June, and we'll hit year-to-date returns, and there's lots of changes to those returns based on what we saw last month. We'll also talk about global fireworks and the dumpster fire known as Greece, which I'm sure a lot of you want to talk about and gain clarity on, and we'll talk about how to approach the chaos to that Greece dumpster fire, how we're approaching it with our clients, and also we'll talk about new services, which I'm very excited about, that are coming to Iron Gate Global Advisors. Our goal is to become the one-stop shop for investors where they can find everything they need, and I think we're becoming closer and closer to accomplishing that goal. So we'll talk about new services that are coming soon for our clients. And those of you that are not clients, I hope this will help gain some more clarity on what Iron Gate Global Advisors can do for you. So let's talk about June for a moment. And I've got this big bear on the screen because that's the mentality right now. As I pointed out in the June video, here's the exact slide that I used a month ago. And I used this, it's not that we were trying to call a top in the market. It's not that we're these brilliant forecasters. It's because we understand history and we know what typically happens in certain months. And it just happens. It's repetitive. It's cyclical. And we talked about the markets turning negative in June, which is exactly what happened. We talked a little bit about the rate decision, although that wasn't headline news. That was more Greece. But certainly we got it right. And we positioned portfolios in a way to take advantage of it in small measure. And I can't get into detail, exactly how we do that. Certainly I can on a one-on-one basis, but not in a video open to the public as a whole. But certainly I would love to talk to you individually on how we position portfolios as the market turns negative and how we take advantage of that. Some of which we'll talk about in the video on a high level. All right, so let's talk about the month of June. As far as the global markets, the S&P 500, which is the U.S., was down 2.7% in June. Not good. Typically, June is down around 0.5%, and it was a little bit worse than normal, but we know that normally it's down, right? So that's how we're positioning portfolios. The developed non-U.S. markets was hit pretty hard, and it was down 4.47%, while the emerging markets were down 3.27%. We're also hit pretty hard, namely China, which we can't get into in this video, but I will address in a upcoming blog, so look for that. All right. So, how did those June returns affect our year-to-date returns? And you can see there highlighted the developed non-U.S., which was the worst performer of June because of that dumpster fire, known as Greece. But let's take a look at the 2015 returns. You can see the U.S. is slightly positive on the year, 0.55%. By the way, these returns are as of today, July 6th. So those are past June. That includes the sell-off last week and today as well. So we've got 0.55 for the U.S. The developed non-U.S. is still leading. That's up 3.29% on the year, while the emerging markets have turned negative, are down 1.43% on the year. So those are the global markets. We also know this, folks, as we understand history. We expected this to happen. We expected June to be kind of a bummer month, right? Just from history. So it's important that you put everything in perspective. It's important that you understand the past to help put everything in perspective for what's happening right now, and we will do that as we continue in this video. Now let's take a look at the sectors. June return, just a couple. I'm not going to point out every one, but just a couple of the sectors, and that is consumer discretionary, lost the least for the month of June. Utilities was absolutely smashed in the month of June, and that's a interest rate sensitive sector, and was just not obliterated, but pretty smashed in June. Year-to-date returns look like this, and that is healthcare is leading the way, and utilities is lagging, down 10%. Now, as far as healthcare goes, those clients that are listening to this know what I'm about to speak to, but we are overweight healthcare. In fact, our biggest position across our portfolios, the stock that we're the most bullish on, and have been for some time, it's up almost 58% this year so far, and that's in the healthcare sector. So we've positioned our portfolios in a way to take advantage of healthcare, and it's happening, and our clients are seeing it. And the other returns in the healthcare sector, certainly 5%, 9% across our holdings. So they're doing relatively well, although we don't have all our money in healthcare, and we wouldn't have all our money in healthcare, but certainly overweight. All right? So that's the June sector recap. And a couple things along this line is, and a note on current market trends. In fact, I know many of you look at charts quite often. You are technicians is what it's called. So I'm going to bring up a few charts, and the charts are of the major global markets. And this is just to set your mind at ease. And I say relax because the trends are still in place. And I'll show you what I mean. The United States, you can see on your screen, I've got 2 moving averages there. I've got a 10 exponential moving average and a 40 simple moving average. When those cross, we get a little bit worried. They are not near crossing. In fact, you can see on the right edge of this, where my little cursor is, that we're pulling back down, which is typically, it's been a great time to buy as the price pulls down to that 40-period moving average, right? So there's the United States, certainly still bullish. So relax, those bears out there. The developed non-U.S., which would include Europe and Asia, also bullish still. In fact, looking to be at a nice support level. If you are looking at levels of areas of support and resistance, certainly that looks good too. Higher highs, higher lows. And then you've got the emerging markets, which is always kind of sloppy, especially the last 5 years, but continues to make higher lows. And could be in what you could call a consolidation, but more of a bullish consolidation than bearish. And so we're still positive on the global markets. And something that I would point out that's very important in determining whether a bull market is over is there's a quote from an investor that I have a ton of respect for, probably as much respect as any investor out there, and that's Sir John Templeton. And he said this, and I've used this before, and I've said it many, many times. But it's so true, it rings true, and it helps, again, put your mind at ease. They're words of wisdom, as I call them. And that is, he said this, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. And if you think of the bull market that we're currently in, I don't know if we could be in optimism, but, we may not even be there. Certainly we're not at euphoria. Euphoria would be when everybody in the world, including the individual at the grocery store bagging your groceries, is talking about the stock market. And that hasn't happened and isn't happening. So I think just according to Sir John Templeton, according to the charts, according to the fundamentals and the growth of the economy, I'm still very positive on the markets as a whole. So relax. And in fact, we will be sending quarterly statements to our clients in the next week. And the one thing we will tell them in those quarterly statements, and something I would tell any investor out there, is first, relax. Second, don't get caught up into 1-month returns or 3-month returns or even yearly returns. We invest, and most investors, at least when it works over periods of time, right? Which is what investing is, longer periods of time. Our focus is 2, 3, 4, 5 years out. And if you need money in the next 2 years, if you're dying to have money in the next 2 years, well, then maybe you should be putting that more in cash and in money markets and not investing that for the next 2 to 3 to 4 to 5 years. But that's our mentality. And it's worked since our firm was created in 1999. And certainly history has proven that it's worked over time. So there's your words of wisdom. Let's go to the global fireworks and address what the global fireworks are right now. And there's a great picture of the 4th of July, but I'm talking about different global fireworks. In fact, I'm talking about something that is happening in Europe, which you all are hearing everything about, and that is Greece on our left versus the EU, and you could even throw the IMF in there, on our right. So what am I talking about? And I'm going to keep this as simple and as high level as possible. I'm not going to get down to the nitty-gritty because I don't think you need it. And I'll explain why I don't think you need it, but let's hit the high details. Here's the high details, and that is that Greece in the next 3 months owes $16 billion to its creditors. And I'll show you who those creditors are momentarily. We know they don't have the money, and they missed and they were the first developed country to miss an IMF payment. So they missed paying the IMF. That happened last week. A lot was made of it, and they've recently voted no to a referendum. And I'll explain what that referendum is shortly. That's Greece's position. They owe a lot of money to several different people, countries, banks, and they just don't have it. So that's their situation. Well, let's talk about the European Union and the ECB and the IMF, right? They have loaned Greece a lot of money. They are the primary creditor of Greece, and this is what they want, right? They want to avoid an EU collapse. They want to keep the European Union together, certainly. They want to get paid back like any creditor would, but they want Greece to make some changes. And this is what the referendum was all about. The EU and the ECB and these creditors, namely Germany, said, hey, we'll give you more money, but we want you to make changes. In fact, we want you to change and restrict government benefits and services and make a lot of changes that way. And Greece then held a vote as to whether they should make these changes and really even stay in the EU, and they voted no. They don't want to do that. They're stiff-arming their creditors. They're stiff-arming the EU. They're sticking their finger up at them in a way, and they're saying no. We're not gonna make those changes. We're Greece, and I'm not sure they have a whole lot to stand on, but that's what they're saying. In fact, let's take a look at the creditors for a moment. Here's their creditors, and this is something I found on Twitter and did some research, and this is where we're at. You can see that the biggest creditors is Germany, France, Italy, Spain, on down the line. In the lower right-hand corner, you see kind of a little circle that points out the total debt, or the total amount of Greece debt that they owe creditors, 312 euro. We're talking billions in euro. 70, right around 77% of that is to the EU/ECB. You can see the EFSF, just in case you're wondering, which is the bulk of that, is the European Financial Stability Facility, which call it the EU/ECB. That's a look at Greece's creditors. So that's where we're at, right? They owe all these people money, and they're saying, you know what? Forget it. We're not going to make changes. And so all these creditors are getting a little bit nervous, and it's causing this uproar in the market. And that's what we've seen in this volatility today. So here's what you should do, and I'm just going to nip this in the bud. Here's what you should do with all that going on. Investors, and I'm speaking primarily to investors, those that have that 2 to 5 year horizon. This is what I want you to do. Relax and enjoy summer. Right? Now, why do I say that? I personally, and these are my, my personal beliefs as to what's going to happen. I may or may not be right, but I think there will be a resolution. I think they'll come to some sort of conclusion that is as much of a win-win as they can. The EU just can't afford to have Greece just leave and forget and just default and lose them a lot of money, right? To put it in a short, nice way. Greece needs the money. They can't default. It would be very bad for them to do so, although many would argue that's the best route for them. Now, let's take a look at this. Although I do think that there will be some resolution, even if they don't resolve this, I look at Greece in a similar way as I look at Detroit. Detroit defaulted, and the U.S., and Michigan and their creditors, they absorbed losses and are still chugging along. I look at Greece as kind of the Detroit of the world. It doesn't really damage the economy. The losses will be absorbed if Greece defaults by the IMF, EU, ECB, but it's really not going to impact the economy, and it's not really going to impact the U.S. a whole lot. So even if they do default, I still say relax and enjoy summer. It's not going to have, 2, 3, 5 years down the road, it's not going to have a huge impact on your portfolio. So I hope that helps, that clarity helps. Now, for traders, for those traders out there that and this is where my mentality is on both sides, but for those traders that want to take advantage of this volatility, certainly I fit that mold, and many of you do. Let's talk about what traders can do right now. And there's a few things, but I want to point out one chart in particular, and that is a chart. I'm looking at the S&P 500, which is the SPY, that orange line, and I have an overlay of the volatility index, which is the VIX, and you hear that word VIX a lot, and a brief high-level review of what the VIX is. The VIX is called a fear index. Basically, it goes in the opposite direction of the market, as you can see. It's that blue line. And I want to keep this, again, high level. It's fear. So when it pops, there's fear in the market. And it's popping right now, far right edge. You can see there's a little circle around it. It's popping. But the important thing about the VIX from a trader's perspective is when the VIX rises, option premiums also rise and inflate. Now, as an option seller, that's what I want. I want those option premiums to inflate. Okay? You can also see that when this VIX pops, take a look at all these circles. When the VIX pops, the market usually is at some sort of bottom. Okay? You can see back in September of 2014, November 2014, the end of 2015. Anytime the VIX pops like it is right now, it's typically a good time to apply certain strategies because the market's pulled back and is in some sort of correction, however you want to define correction. It also tells me options are inflated, which presents other opportunities. So what can you do? What should you be looking at? Traders of the world, or even those investors that want to take advantage of the volatility. Well, I have it in two different categories. I have stock strategies and options selling strategies. So for those people that stocks, I would say this: buy those stocks or even ETFs, mutual funds that you have wanted for a long time. They're probably cheaper than they were 2 weeks ago, 2 months ago. Now's the time to start buying those stocks that you like and ETFs that you like. Now, you may also consider adding to those current allocations, dollar cost averaging, right? You have new money to put to work. You can buy the same stocks that just at a cheaper price. And that's actually something we've done for our clients. We've added to current allocations and we dollar cost average down so that over time that those returns increase hopefully substantially. All right? Now, option selling strategies, there's a few things that you can do. You can sell short, and that's what short means, is selling. You could sell vertical spreads, which we've talked about before on these market commentary videos. You can also sell iron condors, which I'll show you just a quick example of, and then you can sell short puts, which I'll show you a very quick example of and why we do that. First, what we're doing with clients is selling iron condors. The iron condor is a simple strategy that takes advantage of, like I mentioned, volatility in the market and the sideways action that typically results this time of year. As we mentioned, the market is cyclical. This time of year, the market typically trends down, sideways. So this strategy, as we implemented it, as I actually just implemented for clients this morning, takes advantage of that price action. As you can see here, here's an underlying. I'm not going to tell you the ticker symbol that we placed an iron condor on, but I will explain the strategy to you in a very simple way. A iron condor is a combination of two different verticals, a short call or bear call vertical, and a short put or call it bull put vertical. Okay. Now, the iron condor in this specific example, we sold options spreads. Okay, we went out about 50 days. We sold option spreads, and we sold the 1320, 1330 short call vertical. Essentially, what that means in a very simple way is that as long as the underlying stays below 1320, we make money on that vertical. Okay? Now, the short put vertical is very similar in the way that it makes money. As long as the underlying stays above 1130, then we're making money. We sold the 1130, 1120 put spread. So as long as the underlying trends between the two short options, which are 1320 and 1130, then you're making money on your iron condor. So how much are you making? What's the risk? What's the probability? This is not a home run type of strategy. This is a high probability option trade. We're picking up $200 per contract that we sell. There's a 74% probability that it makes money for us. So a high probability trade, we're paid out $200. The risk is $800 per contract, which is the difference between the spreads and the amount we are being paid, and that risk is at expiration. I will do everything in my power to avoid that max loss for our clients as we manage it appropriately. The potential return on your money is 25%. So you're making 25% with a 74% probability in about 45 days. So that's the iron condor, a terrific strategy for income, for enhancing returns, but there is risk involved. And if you've never traded options before or are not familiar with the strategy, then definitely reach out to me before you do anything like this. Now, selling a put is also another strategy that we have been implementing for our clients. In fact, as early as today, we've been implementing this for clients. And this is a particular ticker, which I'm not going to share with you what ticker it is, but it's a ticker that we own for our clients. That's a yearly chart, and you can see that it's trading sideways right now. And that stock, which again, I can't tell you which one, that's for our clients, but it has all the characteristics that we love for buying a stock. You know, it's a value play, which is what we like. And it's pulled back and is trading in a range. And let me show you some options, and I'll explain to you what the selling put is. There's an options chain, calls on the left, puts on the right. And I want to focus on the puts on the right. And I've got in a little square the 70 and 75 put. And if I were to sell the 70 put, that means that I'm obligated, if this particular underlying goes below 70, I'm obligated to buy the stock at expiration, okay? Most likely at expiration. So I can sell the 70 put at roughly $1.30, let's call it, at $1.30. My return on capital, which is that right-hand column, is about 18%. So I can make 18% return on this particular strategy in the next 46 days. That's what that's telling me. Now, the risk is if the stock falls. Guess what? I'm okay if the stock falls because I wouldn't mind owning that particular underlying at 70. So I'm okay with that, right? My break even on this trade is 68.70. My risk is, which is just the strike price less the premium received, $1.30. There's a very high probability In fact, about an 85% probability that I just collect the premium, the $130 per contract, and walk away. But even if I don't, I'm okay holding that stock. The risk being, if the stock drops substantially below 68.70, my break even, then I'm losing money. The 75 put would be very similar. I sell the 75 put for roughly, let's say, $2.65, which is between the bid and ask price. My break even is 72.35. As long as this particular underlying stays above 72.35, then I'm making money. There's about a 70% probability that trade works for me, and I'm getting about a 30% return on capital, as you can see on the far right column, right there, 29.23. Now, if you look and apply, technical analysis to this, you can see that's far below a support level. So I like the income. I like the potential return. I like the potential also of owning that stock at a cheap price. If we can pick it up at 75 or 70 or 68, 70, I'm okay with that, right? Because we think the future is bright for this particular underlying. Those are two quick option strategies that you can take advantage of in the current market conditions, all right? Traders, that's something to consider. That's something we've been doing for clients as it makes sense. We're not just doing it for the sake of doing it, but as it makes sense to their individual portfolios, we will do it, all right? So those are the two strategies, including the others that we mentioned before: buying stock, ETFs, selling verticals, iron condors, puts. It's very sophisticated for a financial advisory that you'll find. And we're proud of that. And we're proud of these strategies and the track record we have for using them. Now, let's switch gears a little bit and let me just finish today's video on some new services that we are going to be providing. And I'm looking for some of these services, most of these services, to be available come fall. And I'm working very hard to make that happen. But just want to let you know that we will be providing Social Security service, including when to claim, what's the best time to claim, what are my different options. In fact, that particular service is available now. Email me if you want to learn more, brett@igga.com. The other services which are not yet available, we're working through legalities and partnerships and different things like that, and that is asset protection, estate planning, and taxes. Our goal, again, is to become the one-stop shop for your investment needs, and we think we're on the right path to becoming that one-stop shop, right? That one place, that one individual that you can talk to for all of your needs. And feel free to email me with any questions you have about any of that. More than happy to address where we're at and where we're going. Now, what did we talk about today in today's agenda? We hit June in year-to-date review. We talked about the global fireworks. We talked about how to approach the chaos, which is mainly to ignore it. And then we talked about new IGGA services that are coming soon. Just a reminder, we've got this education center, which I'm very proud of, which has a lot of these strategies in detail. Take a look. There's my contact information as well. Feel free to reach out with any questions, comments that you may have based on what we've talked about today. Or if you have any questions on how Iron Gate Global can be your investment, your investment advisor, let me know. More than happy to talk and have those discussions. We want IGGA to be your investment thought leader. Email me, brett@igga.com, brett@igga.com. Have a great month. We will talk to you soon. Thanks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.